The dollar is down significantly, falling to the lowest level in almost 4 years as Trump signals his desire for a shadow Fed chair. What is a shadow Fed chair? Why is it happening? What are the implications for the dollar? Why does it matter? And what is going on with the unwind of the $30 trillion carry trade? So here we see the DXY. Remember, this is one way to measure a particular currency is versus other currencies. The DXY is a basket of other currencies, mainly the euro. And what we see here is the daily chart. What we see is the dollar is down. It broke below 98. Here I will zoom out to the weekly. And again, you can see going back, I have to go all the way back to 2022. It was February of 2022, the last time the dollar was at these levels. I will zoom out even farther. Here's the monthly chart where each candlestick represents 1 month. And again, we've talked about this kind of 15-year-long uptrend that the dollar has been in. We've talked about the dollar's overvaluation. We've talked about the drag that this has on industrial capacity within the U.S. and industrial output within the U.S. Strong dollar or an overvalued dollar makes U.S.-made goods uncompetitive. This administration, I firmly believe, wants a weaker dollar. That is the way that you make U.S. goods competitive in the rest of the world again. That is the way that you bring manufacturing back home. That is the way that you address some of the national security implications with outsourcing and offshoring our defense industrial base. That is how you address the national security implications of a net international investment position of negative 100% of GDP. All of these things, the way that you fix it is not with tariffs. It is with a fairly valued dollar, not a weak dollar, not a dollar that is too weak and weaker than it should be, but a fairly valued dollar. On a purchasing power parity basis, the dollar is actually even more overvalued now than it was at the height of 1985 going into the Plaza Accord. And we all kind of know what happened there. I am planning to do a video on the Plaza Accord, so everyone that was commenting that on some of the other videos, don't worry, I am working on that. I do want to point out, though, one thing. So there's a bit of a bullish divergence here with what's called the RSI. I won't go super into it if you're not familiar. This is a widely used indicator within the market participants out there. And what this is an oscillator that measures the strength of a particular asset. And when it falls below this kind of lower bound, that is indicating that it is oversold. When it is above the upper bound, it is indicating it is overbought. And basically, due to kind of chill out, make a little reversal. Market's never going a straight line. And what this oscillator is telling you is the degree to which a move has been kind of overdone. One thing I will note, the dollar made a new low here, right? But on an RSI basis, there's what's called bullish divergence, which is even though the DXY has made a new low, on an RSI terms is actually making a higher low. So that is called a bullish RSI divergence. And then also on the weekly time frame, it is approaching oversold levels. So I kind of am starting to think we might get like a short-term tactical bounce in the dollar, but kind of long-term, I'm still bearish on the dollar. So why is this happening? So overnight, there's some news. You can see this is Bloomberg. There's a ton of articles about this. I will link a video that I did in April on this concept of a shadow Fed chair where I go into it in depth. But I've kind of been expecting this for a while. Basically, Jerome Powell is not cutting interest rates quickly enough for Trump. Trump wants lower rates. He's not getting them. And so what he can do, Powell's term ends in about 11 months, about a year. What Trump can do is announce a new Fed chair, right, which will have to be done anyways eventually. You would have to do that anyways. You announce that new Fed chair now, and then you have that guy go out and just hammer home the point, the dovishness, the point of we will cut rates so much. As soon as I'm Fed chair, we will take rates down significantly. And you basically hammer that forward guidance. Remember, the real power of the Federal Reserve is not their interest rate decisions. The real power of the Federal Reserve is what's called forward guidance. This is where uh, through their speeches, through their comments, through their commentary. They indicate where their policy is going, how they're thinking about the economy, that sort of thing. That's called forward guidance. And it's basically exactly what it sounds intuitively. It's guidance on how they will move in the future, moving forward. And so that's basically all a shadow Fed chair is someone who the market understands, right? The market knows, okay, this guy will be the Fed chair in 11 months, and he's saying interest rates are way too high, and I'm going to cut, by 250 basis points or something crazy. By doing that, by making those comments, the market will react because they know that that is where things are moving in the future. Remember, markets are not reacting. The move you see today is not what is going on right this second. Sometimes there will be news that will move a market in the moment, but in general, markets are forward-looking instruments. They are pricing in, they are discounting future realities. They're forward-looking instruments. So, what the 2-year Treasury yield is doing today is, somewhat dependent on what eco data gets released today, but it's also highly reliant on where the market sees interest rate policy being 6 months from now, 9 months from now, a year from now. So you can get the 2-year Treasury down if you just appoint this shadow Fed chair, get him to go out into the public and announce super dovish sort of sentiment. That'll move the 2-year Treasury down today. It'll have an immediate impact. So here is our yield curve that we look at. Remember, as the maturity is getting further out, it is a darker color. Hopefully this makes intuitive sense for people. I was trying to figure out the best way to color code this. Hopefully that is starting to make sense. What I want to point out, though, is the shape of the yield curve, and this is one way to illustrate that. So we can see that this purple, which is the 30-year Treasury, this is the longest duration Treasury we have. We can see that that has been moving notably higher. Meanwhile, kind of short to midterm rates have been moving sideways to slightly down. What that is indicating is a steepening of the yield curve. So one of the reactions, one of the responses that you would see from this kind of shadow Fed chair concept is a steepening of the yield curve. And sure enough, that is what we've seen. We have seen longer rates move higher, right, as measured by, say, the purple, which is the 30-year, or the blue, which is the 10-year. Those have moved higher since the Fed started to cut last September. Long-term rates have been moving higher. Meanwhile, short to medium-term rates have been moving sideways to slightly down. That is a steepening of the yield curve. And another way to illustrate that is by just taking a spread of the two yields. So you take the 30-year yield and you subtract the 2-year yield. What you get is this line here. And what this indicates is, here in April of 2011, the 30-year was yielding 3.8% more than the 2-year was yielding. That is what this white line is representing. The dotted red line is at 0. I have red shaded recession, NBER recessions. That is what these red shaded areas indicate. I'm doing a video on the cause of recessions. There's a commenter that I've gone back and forth with a number of times that always points this out regarding inverted yield curve. And I am doing kind of a what causes a recession sort of video that is planned. I'll have that out this week. But in general, what I want to show is that the yield curve inverts. So what that means, remember, you should be getting a higher yield on the longer maturity. And so when this goes negative, what that is indicating is that you're actually getting a higher yield on the 2-year, on the shorter maturity. That is what an inverted yield curve means. And what you can see is that going back, my data only goes back here to the 80s, but before every recession, the yield curve will invert, and then it'll uninvert, and then generally that's when the recession actually hits. You can see that is a tale as old as time going back here. 2020 was a bit different because that was kind of like a black swan thing that kind of came out of nowhere. But in general, more the business cycle, vanilla sort of recessions, the yield curve will invert, the recession will hit, and the yield curve will steepen. But the reason the yield curve will steepen is what's called a bull steepener. So this is where, short-term rates, all the rates are coming down, but short-term rates are falling the quickest. So here, 2008 is probably a good example. Here we can see the short-term rate as measured by, say, the yellow or the orange. All the rates are coming down into the 2008 GFC, right? All the rates are coming down, but the short-term rate is coming down way faster than the longer-term rates are coming down. This is called a bull steepener because remember, the value of the bond is inverse to the yield. So this is what the value of the bond would look like. The 30-year, the value of the bond is going up. That's bullish, right? For the bond, not for the yield, but for the bond, that's bullish. It's also bullish for the 2-year because the value of the bond is going up there too. So that's why it's called a bull steepener. But what we're kind of seeing recently, again, is since the Fed started to cut last September, is a bear steepener, which is where yields are rising. It's just that longer term treasuries, the yield is rising quicker. So they're two different things, and they indicate totally different they have totally different implications. So here we can see that right now the 30-year is yielding about 1% more than the 2-year. This is a normal yield curve. Now you'll notice we inverted here in 2022, 2023, didn't have a red shaded NBER recession. We actually did in 2022, we had a bear market in the S&P 500, and we also had 2 consecutive quarters of negative GDP growth. Now, they didn't declare an NBER recession. That's a whole different discussion, but we did have a lot of the conditions that you would generally see in a recession, like a bear market in the S&P 500, two consecutive quarters of negative GDP, and all that kind of thing. Now, this is also influenced by the issuance and the way that the Treasury is issuing the debt. We've talked about that before. There's a number of factors going into the inversion here and the lack of a recession that we won't get into in this video. But suffice to say, with a shadow Fed chair, this is a very emerging market-like behavior. Countries like Turkey have done this. And what Trump, I did a video on this as well a couple days ago, maybe a week ago. Trump made some comments where he's basically saying, yeah, I want to cut the overnight rate, that the white line, the Fed funds rate, I want to cut that by 2 to 2.5%. So right now it's about 4.3. That would be a significant cutting of the overnight federal funds rate. And what that would do is it would bring down the short-term yields, right? So the 3-month would come down, the 1-year would come down, the 2-year would come down. And then you could just issue all the debt at those short maturities, basically funding the government via payday financing. And, of course, this could theoretically work. There are consequences, though. One of the consequences is you get a steeper yield curve. And this can come, like I mentioned, a number of different ways, but I think that the yield curve will steepen. What this means is long-term rates will not come down relative to the short-term rate, like the 2-year. Long-term rates, the difference between long-term and short-term rates will actually get worse. That is called a steepening of the yield curve. So remember, mortgages are priced off of long-term rates. Car loans, the interest rate is priced off of long-term rates. Credit card interest rates are priced off of long-term rates. The Fed funds has very little, if any, influence over, say, a mortgage rate. So eventually, higher rates, a steeper yield curve will dampen, real economic activity, like in the housing market, like with car loans, like with credit cards, until eventually they have to come in and QE or yield curve control or whatever you want to call it to bring down the long-term rates. Well, the problem with issuing all your debt at the short end and pulling the emerging market playbook is the market knows exactly what you're up to. They know it's very inflationary. And so what you get is the long end of the yield curve, like the 10, certainly the 20 or the 30. Those yields can go up very sharply, very quickly, if they think that they're about to be financially repressed, which is the fancy term to describe inflating the debt away. Long-term rates will go up sharply and quickly. Now, again, that'll have real implications, if and when that happens. And eventually, the government, the Fed, the Treasury, will need to come in to print more money to buy long-term rates down, basically. Remember, buying a 30-year bond in mass will bring the 30-year down. They are inverse. So what you get is a steeper yield curve, dampened economic activity until eventually the yield curve is so steep that dampens economic activity so much that either it causes a recession, which is basically a margin call on the debt, or you get into a situation where the Fed has to QE. And in that situation, that is even more inflationary, right? Issuing all the debt at the short end, bringing short-term rates down, issuing all the debt at the short end, that is inflationary. When that causes the curve to steepen, eventually that'll lead to QE or yield curve control or whatever. That is also inflationary because they are printing bank reserves out of thin air to buy those long-term bonds. So it's, I don't think it's going to really work, Trump's kind of strategy. Here, I want to kind of touch on the issue of a shadow Fed chair and that issue of forward guidance. And I want to just show that before the Fed cuts, right, which is in red, this is the overnight official federal funds rate. Before the Fed cuts, the 2-year yield is moving, right? So we could see that before the Fed hiked, the first Fed hike here in 2004, this was June of 2004, but look at when the 2-year bottomed. It bottomed, a year before that. And had moved higher by the time that hike actually happened. By the time that hike actually happened, the 2-year had gone from 1.1 all the way up to like 2.2. It was already up 100 basis points off of the low. So again, the power of the Fed is really forward guidance. And I would also say that the Fed really just follows the 2-year yield. The Fed is not as powerful as a lot of kind of older, more traditional sort of people look at the Fed and look at monetary policy. I am much more in the camp that all their, a lot of it is just kind of kabuki theater, and they're just following the 2-year yield. Now, remember, you get this shadow Fed chair to be very dovish and talk about, as soon as I'm in, I will be taking rates down by 250 basis points. The 2-year yield will fall. Now, it's probably not going to fall 250 basis points that day, but it will fall. And that is the effect. That is what we can see. The 2-year yield also starts moving higher before the Fed starts hiking, right? So hopefully that relationship is clear. You can also see it here, which is the spread between the 2-year yield and the Fed funds. So why is Trump doing this? So here in red is the federal funds rate. This is the overnight interest rate that the Fed controls. And then here we have two measures of inflation. What I want to show is that when the Fed started to cut interest rates here in September of 24, what were these inflation rates doing? So core CPI was 3.3%. It is now 2.8. And then core PCE, which is personal consumption expenditures, just another way to measure inflation. This was at 2.7, and it is now 2.5. So remember, the Fed mainly uses core PCE, excuse me. But when the Fed started to cut rates in September of 2024, right before the last election, inflation was just objectively speaking higher than it is now. Remember, the Fed wants to see lower inflation before they cut, generally speaking, or at least that's what they've been saying, is that the reason that they held rates so high and didn't cut was because inflation was elevated and above their target. Well, then in September, they kind of showed that that was all fake to some degree, and they cut interest rates even though like core CPI was 3.3%, which is notably above their target. And not only did they cut, but they cut by 50 basis points, which, a jumbo cut that is generally only seen kind of in, I don't want to say, financial disaster, catastrophe, but, pretty severe economic stress. And we definitely did not have that. So here's another way to kind of think about this. Here's the Fed funds and real GDP growth. So again, when the Fed started to cut rates in September of 2024, real inflation-adjusted growth was actually higher than it is now. So real growth on a year-over-year basis was 2.7%. But if you look now, it's only 2.1%. So again, the Fed shouldn't be cutting. The reason for Fed cuts is to stimulate growth. Generally, you cut rates when growth is too low, right? You're trying to bring growth up. So you cut rates, that's stimulatory. You cut when growth is low and when inflation is low, right? Because remember, inflation is kind of just another way to think about overall growth, right? Inflation generally correlates to growth. unfortunately, just kind of how it is. So generally, you hike when inflation is high and when growth is high. What we saw is, we established that inflation was actually higher right before the election when the Fed started to cut, including a jumbo cut, 50 basis points. Well, not only that, but growth was also higher. So if there was ever a time to cut, it is, with growth 60 basis points lower than it was when the Fed started to cut, and inflation, depending on how you measure it, significantly lower than where it was when the Fed started to cut. So there is an argument here. I'm not trying to make an argument one way or the other. This is just kind of the objective truth of it. But there's an argument from within the administration that the Fed is being political. He's not cutting rates because he doesn't like Trump. And remember, this goes back to 2016 during the first term when the Fed was hiking rates and also engaged in quantitative tightening, which is also kind of the antithesis to a hot economy, right? Is to slow the economy down. He was hiking rates and engaged in quantitative tightening during Trump's first term. This kind of quarrel goes way back to Trump's first term. But the argument from within the Trump administration and from Trump himself is that Jerome Powell is being political. There's some degree of truth that you could use to back that argument up. I don't know either way. I'm not in Jerome Powell's head. There is, like I said, though, inflation was higher when he did that 50 basis point jumbo cut, and growth was higher when he did that 50 basis point jumbo cut, and then the subsequent 25 basis point cut. So he's kind of got a point. Now, whether or not that's because of some nefarious reason, he hates Trump, something like that, that I think is more of a stretch, and you would need to have more evidence to make that claim. But that's at least how Trump is thinking about it. And I think it's important to at least try to understand the mindset of why these things are happening. That's why Trump is so upset. Is he believes that the Fed should be cutting and is holding off due to political reasons. Now, like I said, there is some data you could find that indicates that there's some degree of truth to that. And I think that the Fed is going to be cutting anyways. With inflation doing what it's doing, with growth doing what it's doing, the Fed is already going to be cutting 50 basis points this year. So, like, some of this is kind of inevitable and kind of already baked in the cake. So, how important the shadow Fed and the Trump, dynamic and all this kind of stuff, like the Fed is already expected to cut 50 basis points this year, anyways, due to inflation falling and growth falling. And kind of basically what I'm trying to say is the need for rate cuts. So some degree of it is kind of already priced in. And so here is the S&P 500. So what I want to show in terms of a weaker dollar, one of the implications goes back to this concept we've been talking about a long time of the dollar carry trade. So there's tens of trillions of dollars in this particular trade, over $30 trillion in on a net basis. So in terms of what foreigners own of our assets versus what we own of theirs, there's over $30 trillion that foreigners own of our assets. Well, one of those assets is equities, like the S&P 500. This is just kind of, one of the proxies, one of the ways to measure that. And what I want to show is that in US dollar terms, here this goes back, I will start it at the beginning of the year. So this white line shows the S&P 500 in dollar terms. And sure enough, we're up 3.9%. Everything's great, right? Well, no, if you're a foreigner, things are not so great. In fact, if you're a foreigner, things are much worse. So here I have the euro, the pound, the yen, and the Korean won. And so what we see with those is that if you are that foreign investor, due to the fact that the dollar is down so sharply since the beginning of the year, your return is actually negative. So remember, looking at things in nominal US dollar terms, sure, if you're a US investor and all you care about is your return, sure, then, I guess you could look at the nominal return. But what is going on with, a sharp move like this, 10% move in the dollar in a matter of a couple months, a quarter or two, that is significant. Well, one of the reasons it's significant is that those foreigners that had just piled into US assets, Even though in dollar terms, the S&P 500 is up 3.9%, they are actually still down on a real basis for them because the dollar has depreciated during the time that they have been in the S&P 500. Just as an example, during the period of time they were locked in the S&P 500 and therefore basically long the dollar. During that time period, the dollar has weakened, right? So you have to think, for a foreigner, they're kind of making two trades. When they buy the S&P 500 or the Nasdaq, they are basically making two trades. They are buying the S&P 500 or the Nasdaq, but they are also buying the dollar, and they are long the dollar. Now, of course, they can hedge. A lot of this is unhedged. From what I've gathered, about 10 trillion of equity exposure is currency unhedged. So what happens is, at the height of this sell-off during April, some of these investors were down 20% in just a couple of months. And again, adjusting for the move in the dollar plus the move in the S&P 500 or the Nasdaq, right? So that sort of move, shakes them out, and they are still down on their position. In fact, they are well off the all-time high, while the S&P 500 in dollar terms is approaching an all-time high. It might have hit it since the market opened 10 minutes ago. Might have gone up and touched it. Well, in dollar terms that might be true, but look at all these, once you factor in the dollar's weakness, we are well off of all-time highs. In fact, we are like 10% off all-time highs for these foreign investors. So this will be a continued headwind for the dollar, in my opinion, kind of medium to long term, as nothing ever moves in a straight line. And like I said, the dollar is approaching kind of oversold levels. So we might get somewhat of a bounce, but kind of medium to long term, this, leads to pressure. This leads to pressure on equities, leads to pressure on real estate, leads to pressure on bonds, right? Because what a foreigner would do, they sell the S&P, they sell the house, the real estate, they sell the bond, right? Now they have dollars. Then they sell the dollars to get out of that dollar long and into their other currency, right? Their local currency, or maybe a different currency. Maybe you live in Japan, but you really like the Swiss franc. Okay, well, regardless, you're selling the dollar. And so that's why we see the DXY down 10% year to date, is because foreigners have been selling the dollar. This is why mechanically, this is why the DXY does this. What it represents is that foreigners, or market participants, and broadly speaking, are selling the dollar to buy other fiat currencies. If you get a shadow Fed share, I would expect that to be to cause significant dollar weakness. Now, there is a question of how much of this move is pricing in the inevitability of shadow Fed share, right? I don't think it's 100%, but I am fairly confident that some of this move down in the dollar is pricing in the likelihood of a shadow Fed share. But in general, it's inflationary. It's bad for the currency. It's bad for the dollar, which is then, again, remember that drags down the overall return for these foreign investors if they're in US dollar denominated assets like the S&P or the Nasdaq. It brings this return even lower, right? Which might cause selling, which can snowball. And it's very inflationary. It'll cause the curve to steepen. It'll cause this spread, in my opinion, the 30 minus 2 or the 10 minus the 2. I think it'll cause the curve to steepen. It'll be inflationary. It's very emerging market like. And again, it'll work theoretically, quote unquote, until eventually things get so bad and the long-term rates are so high and inflation is so high that, it kind of just accelerates and gets even worse from there. So anyways, hopefully that was helpful. And I am working on some of those other videos I mentioned, but can only do kind of one at a time. So this was pretty big news. I think dollar down to, lowest level in almost 4 years, 3.5 years. I think this is starting to signal something important going on. We've clearly been talking about this for many, many months, if not if not a year. But it's certainly something to keep an eye on. So anyways, hopefully that was helpful, and I will catch you in the next one.